just getting started, just getting warmed up. The second seminar this morning is hosted by BVC title sponsor Jones and Roth CPAs and Business Advisors. Speaking today, we have Senior Manager Jordan Dawley. Jordan is a native of Bend. His specialized areas of expertise include strategic tax planning for individual and family clients, as well as business tax and advisory across a wide variety of industries. He is an active coach and advisor, working closely with his clients to achieve short and long-term goals. Jordan serves as a key member of the firm's healthcare and dental teams and as an audit chair of the local chapter of Risk Management Association. He graduated from the University of Oregon with bachelor's degrees in accounting and economics. Welcome, Jordan. Where are you? Here you are. Hi.
How are you?
Good to see you. Okay, take it away.
That's my clicker. Beautiful. Fantastic. Well, good morning. How's everyone doing today? Good. Great to see y'all. We're excited you're here. I selfishly look forward to BVC every year, not only because it's a fantastic event, but it also represents to me that tax season is over, right? So if you have not filed your taxes, Monday was your deadline. Get them in. So every year, colleagues are like, why do you do this? Why don't you take some time off? I'm like, this is my hurdle at the end of the year. So appreciate y'all being here for this. We're going to take time today to talk about some tax smart considerations for entity formations, things to think about for startups in general, and things like that. So happy to answer questions as we go. I know this is maybe like watching paint dry at times, talking accounting. So bear with me, and certainly let's engage and ask questions where you have them. So let's skip right through that. Let's talk a little about Jones and Roth for those who may not have heard of us. I know Shannon had a fantastic intro for myself, written by my colleague. But Jones and Roth, right? So we like to call ourselves a premier accounting firm based here in Oregon. We have offices here in Bend. We have an office in Eugene and Hillsborough as well. And we work with clients in a variety of industries, not only in tax, assurance, and advisory work, but specifically, right, I work a lot with dental and healthcare, but we also have clients in the construction space, nonprofits, and the like. So let's connect if you have a need in those areas. All right, so let's get after it today. We're going to talk about legal formations and what those implications are from a tax standpoint. We'll also talk about what things you want to consider from your accounting method elections and the implications those have. We'll talk about some of the costs of starting a business and how those are treated from an accounting and tax standpoint. We'll touch on intellectual property a little bit as well. And like I said, there'll be Q&A at the end, but there's a lot in each of these sections, so please jump in if we have questions on anything in particular there. So the legal folks in the room will be proud of me. We've got a disclaimer, right? This is my information. This is not endorsed by the firm specifically. And it's deliberately generic, right? Like all things in tax. When we're asked the question, the answer is often, it depends, right? Because it's fact pattern specific. So please reach out to a qualified CPA. I happen to know one if you need help to your specific circumstance. All right, let's talk about the 5 main legal entities. We're going to talk about sole proprietors. We'll talk about general partnerships, we'll talk about C Corps and S Corps, and then we'll touch on LLCs as well. All right? So sole proprietors are the most simple formation. They require no legal formation, but by rule, it's one individual, right? Hence the term sole, right? So it's one person. The tax reporting is actually pretty simple on those. It's filed along with your individual tax return directly on a Schedule C. What's important to note, like from a legal standpoint, is you have no limited liability protection. So your personal assets are subject to creditors if and when there would be a claim on those assets. From a tax standpoint, all of the net income, assuming you're profitable, is subject not only to income tax, but you're also going to pay self-employment tax on that income. And that's 15.3%, so it can quickly add up. So that's a little bit about a sole proprietor. We see tons of these for a variety of industries. And what's nice is you can quickly convert to another entity structure if and when the time warrants. So don't hit the panic button yet if you're a sole prop. There's ways to do other things. So general partnerships share some commonalities with sole proprietorships. The main one being there's not necessarily a need for legal formation right out the gate. The contrast there would you have to have more than one owner specifically to be a general partnership. Tax return-wise, we filed a 1065. This is what's called a pass-through entity. I don't know if you've heard that term before, but a pass-through entity, the business itself does not pay income tax. Instead, those are distributed out, or reported, I should say, on a K-1 to the individual owners, and they are responsible for the income tax downstream, okay? So that's the pass-through aspect of that. Similar, right? If you don't have a legal formation, you have no limited liability as well, right? So your assets are at risk as well. So one of those things to consider from a protection standpoint. Similar to a sole proprietor, the income that is attributed to you on the Schedule K-1 is subject to self-employment tax, again, that 15.3%. That's just a little bit about partnerships. But one important thing to note, people often ask, is like in the startup environment, yes, the business make money, but we kept the money in, right? We reinvested it to continue growing. And kind of the downfall here is you are taxed on the income, whether or not you actually take it as a distribution from the entity. So just be aware of that little wrinkle there. All right, C corporations. C corporations are quite popular for venture investors, angel investors, and there's a few reasons for that. Let's talk a little bit about C corps in general. Is they're effectively a corporation that has not made an S election, and we'll talk about S corps in a minute. What's different about a C corporation is it's its own tax entity, right? So you would pay corporate income tax on the profits of a C corporation, and then the owners would pay their own income tax on any dividends or wages they receive from the C corp itself. That tax form is a 1120, and like I mentioned, there's kind of this funny double taxation that occurs, I should say, in a C corp, where the dividends you pay to owners are not a deduction against the income of the C corp itself. So you're faced with two layers of tax: the corporate tax and the taxes for the owners as well. And then it varies by state, but Oregon specifically has a gross receipts related tax. So depending on where you operate in, you may be faced with a state local tax as well. This is a requirement in an S corporation as well, but C corporation officers or owners who are involved with the day-to-day, they do material business or work, I should say, for the C corp are required to receive a reasonable salary. The IRS does not define what a reasonable salary is. There's a whole lot of metrics as to what that would be, but effectively it's basically what you'd pay someone else to do the work you're doing. So keep that in mind. The nice thing about a C corp is liability is limited to the C corp itself as long as you observe the corporate formalities, right? You have a board of directors, you meet annually, and you keep board minutes, for instance. This structure specifically is not usually the most efficient when we're talking about closely held businesses. And again, the main reason for that is the double taxation that occurs, okay? To contrast that, as I mentioned before, this is the preferred vehicle traditionally for angel investors because the income that's generated has no impact to the angel investor themselves until they are paid, right, dividends for their investment, or if it's acquired, right, they effectively sell their stock for a gain at that time. And there's also flexibility relative to the number of share classes and priorities and different rounds of funding. All right, so S corporations, this seems to be like the TikTok thing. Everybody talks about S corps. It's super popular to assume you want to be an S corporation out the gate. And I think, honestly, one of the reasons that comes up so immediately is when you contrast a sole proprietor or a general partnership who pays self-employment tax, right, that 15.3%. An S corporation, its bottom line net income is not subject to self-employment tax, right? So the natural inclination is to assume you're going to save 15.3% in tax just by becoming an S corporation. And it's not quite that simple, right? Because as I alluded to, as an officer or owner of the company, you have to pay yourself a salary, a reasonable salary. And you're now the owner and the employee, so you're paying both sides of FICA taxes, Social Security and Medicare, right? So that's effectively 12.9%. So quickly, depending on how much you pay yourselves in wages, that savings usually comes down somewhere between 3 to 5% from that standpoint. So just to kind of eliminate that assumption that S corp is not always best. And there's some other reasons why that's the case. There's additional restrictions on an S corp in terms of who can be owners, right? You can have no more than 100 owners at one time. So some situations that could be a limiting factor. Also, you can have you can have no foreign individuals as owners as well, or other business types cannot own stock as well. A partner. Did I hear a question? Yeah, go ahead.
Yeah, in regards to the no foreign individuals.
Uh-huh.
What if they have a corporation in America, but they are in this country, and the corporation is actually a partner?
Like the C corporation, yeah. So a C corporation unfortunately can't be an owner in an S corp. It's one of the dynamics, the restrictions of an S corp. So that's unfortunately not a way to get around it. But good question. Thanks for bringing that up. Okay, so yeah, an S corp is similar to a partnership in that it's a pass-through entity, right? So the S corp's not going to pay the tax; it's going to come downstream to the owners themselves, and that's done on a Schedule K-1. S corps do not have the double taxation as a result, right? So that eliminates that detriment from the C corp. Similar as a C corp, we have limited liability as long as the formalities in general are observed. The biggest downfall here with an S corp is you have one class of stock, right? So you cannot have preferred, common, and other types of shares. Everybody has one class of stock, and everything's treated pro rata in an S corporation, meaning if shareholder A takes $25,000 out as a distribution and he's a 25% owner, the next people have to take their pro rata share of distributions as well. And likewise, we have no special allocations of the income deductions or credits in an S corp, whereas we do have some functionality dependent on your partnership agreement that you could have special allocations of income and deductions in a partnership. Okay. The main reason the outside angel investors typically would not look at an S corporation is that one class of stock, right? And they're effectively going to wait on the K-1 to be able to file their tax returns, right? That's part of their tax filing. So that's a little bit of a hindrance there. But the biggest thing is if a company's growing and reinvesting their money and not distributing funds out, you're going to be taxed again on that money whether or not you receive it. So an angel investor sitting there having K-1 income reported to them of $100,000 with no relative income distributed to pay the tax, right, is as a detriment from that standpoint. All right. LLCs, right? So I often get calls from clients, they're forming a business, and I say, what type of tax entity are you? And they say, we're an LLC. An LLC is fantastic, right? An LLC is a legal construct, however. It specifically formed under state statute, so it's a legal protection, but it does not tell us how you're going to be taxed, right? You can be an LLC and be a disregarded entity or a sole proprietor, right, effectively. You could be an LLC and be a partnership, or you can be an LLC and be an S corp. There is different language on an LLC. We call the owners members instead of shareholders or partners specifically. And you can form, as I mentioned here, with one or more partners or members, I should say, could form an LLC. But what gets tricky in an LLC, the operating agreement, the legal document, right, that says how the LLC is going to operate could contradict the tax treatment of that entity. And what often happens is people will form an LLC and have language drawn up with different classes and different membership units and priorities, and then they come and they want to form an S corporation, and they would need to go amend, right, their LLC operating agreement to reflect the tax election, right? So that's one potential downfall. Although it's fairly easy to get around, you just got to have good tabs with your legal team and be ready to pivot if and when those decisions are made. All right, any questions there before we jump? Yeah, go ahead.
Is that only in relation to switching to an S corp, or if you switch to a C corp?
On the LLC? Yeah, so you'd actually incorporate at that point to become a C corporation?
Elect to be taxed as a C corp, but remain an LLC, right?
I mean, you could, right? But you'd want your language to be reflective. What often happens, right? So as I alluded to in talking, right, there's different references to different components of the different entities. So a partnership, for instance, frequently references how you treat capital accounts. And that's a unique issue specific to partnerships. One instance would be like a debt restoration obligation. If your capital goes negative, do you have to restore that capital? And if you have language such as that relative to a C corp, it's kind of contradictory, right? So you have tax saying one thing and legal saying another. So you'd want to marry the two to have the language reflective of what your tax entity is. Great question. Any others there? Yeah, go for it. Could you go from an LLC back to C corp, or? Yes, you can. Yeah, we'll get into that a little bit here in a minute. You can convert, right? There's ways to do so, and there's potentially ways to do so as a tax-free transfer. But there's also periods of time where you have to maintain as a certain entity, right? And that's more relative to going from a C Corp to an S Corp. But there are periods, like for instance, in the event of going from a C Corp to an S Corp, you have a 5-year period, right, that you're subject to what are called built-in gains, right? And so there's certain considerations as to why you may or may not do that and the time frame relative to that. And another thing about C Corps, go ahead. Oh, I was just going to say another thing about C Corps that we'll get into here in a minute is the qualified small business stock. Section 1202 is this unique provision about effectively having a tax-free sale, tax-free liquidation of the C Corp upon sale. And that only comes about if you are initially a C Corporation, right? So if you started as an LLC and go to a C Corp down the road, that 1202 provision that's so attractive to growing companies is out the window for you. So, yeah. Go ahead. Where to incorporate a C Corp specifically? Yeah, great question. And yeah, that's the legal side of the house more effectively, right? Because if you do business in wherever you're located, right, whether that be Oregon or elsewhere, you're going to pay tax on where the work is or where the job you're doing. So from a tax standpoint, that really doesn't move the needle. I know we often hear. I met with a client the other day who said, "Hey, I went ahead and I formed out in Delaware, so I'm not going to pay Oregon taxes." Well, unfortunately, he's a resident here. All the work is performed here, so he's still subject where he's located. But so that's more the legal side of consideration, and I believe it has to do with the generosity towards businesses and entities themselves in certain locations. Montana's been popular lately. Delaware's been famous for quite a while. But yeah, that's more the legal consideration. Yeah. Go ahead. So if I heard you right, you said in what way can an LLC member who's an owner in a C Corp draw their salary into an LLC? Yeah, so the salary itself would have to be paid to an individual, right, who holds the stock. So if it was you yourself, you would have to receive the salary, right? We can't pay a wage to an LLC specifically. Yeah, great question. All right, looks like we're good for the moment. Go ahead.
But you could technically reduce your salary, split it, and pay at the LLC, and then pay your salary half, right?
Well, so here's the thing: is as you're alluding to, I assume, are you talking about an S corporation specifically?
No, with regards to what he's
In a C corp, yeah. So
you take a lower salary and then take a payment from that to an LLC,
sure,
basically equaling what you want as a
yeah.
salary wage.
Yeah. You effectively, you're basically what you're getting to at any point of deciding reasonable salary and distributions or dividends paid is what is total compensation relative, and then what are wages relative to the work to be performed. And so what's interesting to me, actually, I know it's my job, but I find tax law quite interesting. And if you think of it as kind of like a social construct, it's almost like they're pulling levers to encourage certain behaviors, right? Probably most popularly recently, right, is like electric vehicles, right? They're trying to do everything they can to get people to buy electric vehicles. Tax credits, certain income limits, all those apply, but that's the incentive lately, right? So they recognize there's advantage in terms of having small businesses, growing economies, providing job opportunities and all that. So they give preferential tax rates. Like a C corporation's top tax rate is 21%, right? It's 39.4, 39.8, I think it is for an individual. So that's one of the incentives in terms of business ownership is having a lower tax rate on the business itself, right? But one way they do in terms of balancing budget on tax collection is they require certain things, right, as a balancing figure, right? And one of those is payroll, right? And so when you pay payroll, of course, that's subject to income tax, Social Security, Medicare tax. So yes, you can split, and you do split payment sources from wages to distributions or dividends. But the big overriding factor is the wage portion has to be specifically has to be reasonable. And it's a fact pattern specific, but if you want to talk about that further, we can get into that. Office hours, I think Shannon plugged that. Yeah, there they are. So we'll be on.
Basically, you're telling me my theory is the model is down.
Mafia style, yeah. You could do it. Honestly, it's we bring this rule up because it is a requirement, especially like an S corporation, right? You have all these rules you have to follow, and if you don't follow them, it breaks your S corporation, which has a pretty horrible tax effect if and when that occurs. And one of the ways they do it, again, tax returns are effectively data collection, right? And they have a whole slew of expected metrics relative to revenue and compensation and whatnot. The biggest red flag is to play zero, right? I had a client who recently, right, we looked at her return. She had paid zero salary, and I said, "You're going to break your S corporation." She goes, "Well, if they do that, I'll deal with the consequences." And what would happen in that circumstance is instead of that being a pass-through entity, that would be treated as a C corporation. So all of her profit would be subject to corporate income tax, and all of her distributions, which would be tax-free in an S corp, are taxable dividends in a C. So it could be really horrible. So that's the big disclosure: is great tax formations, great entities, but follow the simple rules, and you'll be copacetic with the agencies. Yeah, go ahead. Is there a workaround to C corporation double tax? If there was, I would probably have a much nicer office than I do right now. But no, just to kind of re-highlight, like, so the double taxation, right? As an individual, you're subject to income tax yourself. If you're a business owner as well, and you're a C corporation, the business pays income tax, and any compensation you receive in the form of wages or dividends are taxable to you as well, right? And so the big thing to think of here in terms of like, how is it double taxed? The dividends you receive are not a deduction for the business. So if the business made $500,000 and you took $400,000 of dividends, the business is going to be taxed on $500,000 and you're going to be taxed on $400,000, right? And yeah, there's not a way around it. Typically, so this is what people do from a tax planning standpoint as a C Corp, and it depends, again, fact specific, but what people do is they zero out the C Corp income before year end. And they do that by paying themselves like bonus wages, right? Or funding retirement, things like that. But again, you're still paying tax, it's just one layer of tax. But that's one way from a planning standpoint to consider strategically modifying your decisions. Yeah, go ahead. Is there an exception for smaller businesses to not be? Like on a C Corp specifically? Or yeah, I mean, the top rate is 21%, right? So if you have low or no income, you're going to pay much less tax or no tax potentially. Oh, on the dividends, I'm sorry. Yes, dividends, right? I think are you talking about the qualified small business stock? Yeah, we'll get into that here in a bit. That's a really specific provision that we'll talk about in here a bit. So I'll defer to that. So anything else? Oh, yeah. All right. This is fun. Everyone's excited. This is great. Go ahead. Yeah. Yeah. So we'll get into IP here in a bit. We'll talk about R&D and stuff like that here in a little while. All right. So we talk about, this is just a nice summary my colleague put together to kind of compare and contrast some of the considerations, right? If unlimited liability does not scare you, it should scare you. These are just fine to form without any legal formation. And of course, we have protections outlined in S Corp, C Corp, and LLC, assuming you follow the necessary steps there. And again, great way to point out, right, that C Corps are the preferred vehicle for angel or venture investors for the reasons we discussed before. S Corps can be fantastic vehicles for a lot of things, but you're not likely going to get that outside investment. And actually, LLCs, there's a lot of nonprofit-related investors that are unable to invest in LLCs specifically. So, I always say kind of start with the end in mind in terms of what your goal is. And of course, that can change over time. But you may start as a startup and think, I'm going to grow and sell this thing and then do something else and, like kind of roll from there. That's some of the BVC mindset, and I love it. I love to see that. But sometimes you just hit an activity and it's a gold mine and you just figure, I'm just going to ride this cash cow and go from there. So we like to be mobile or nimble, I should say, relative to your circumstance. All right, so as we talked about just a brief while ago, this is that slide for that gentleman there, right? It is possible, right, to change entity structure, and frequently, right, there's tax-free transfer opportunities to occur. We talked a little bit about, right, not wanting to go from C to S and trying to revoke that election, right? They certainly don't want you to attempt to go back and forth between entity types, every year, and that's specifically precluded, so be aware of that. All right, so we've touched on this a bit, considerations and exit. There's really two ways that a business is sold, right? And one's by selling the stock of the business, and one is by selling the assets of the business. And it depends on what the actual business is or what the end goal is in terms of what transaction occurs. To answer that lady's question back there, in terms of a C Corp, the easiest way to avoid double taxation is for the stock to be sold, right? Then all owners are just taxed as if they sold like a Microsoft stock, right? That's much simpler. If you were to buy assets, now you got to liquidate the assets, you're going to recognize gain and then pay out dividends to owners. You're going to famously treat that double taxation from that standpoint. So I touched on a little bit here, the gain exclusion relative to the qualified small business stock, right? That's the section 1202 I mentioned. You have to form as a C Corp out the gate, and it has to be a C Corp formed after 2010. What's funny is it's September 27th of 2010, right? And I think the date might be up there. Yeah, it's up there. And I always presume that there's somebody in Congress who goes, they're proposing the rule and they say, let's do it September 30th. And there's someone in Congress going, hey, I just formed one a couple days ago. Can we push it back to the 27th? So there's always some odd date. That it's not a year end, it's not a quarter end, right? September 27th. So I'd love to know the backstory as to why they chose that date. Somebody got a sweet deal. I know that's for sure. All right, so I'll pause here and see if we have any other questions specifically to entity formation type stuff. We answered quite a bit, so maybe we'll keep going. If we're good, looks like we're good. You got one? Go ahead. Uh-huh. It depends on what stock is selling. Would be the parent or some of the subsidiaries, or yeah. So it would be the entity that sells the stock. That one would have to be an initial C Corp to qualify for that big exclusion, and potentially, yeah. So I'm going to kick back to it depends, right? But yes, potentially the fact pattern you've described, it's possible. Absolutely, yeah. Great. I'm not forgetting about you. Go ahead. Yes, right. Yep.
On the QSBS, will you just give a little more color on the 10 million or the 10x basis and how that affects whether you're
Oh, yeah, sure. So you're able to exclude up to $10 million of the gain itself, right? And so if you started the C Corp and it grows in value dramatically and you sell it for 100 million, you're only going to be able to exclude up to 10 million of that specifically. So, yeah.
or like if you're the money, you get 10 extra basis, right? So if you put in $10 million into the fund, you can actually get it.
Sure. Yeah, and there's basis modifications as well. Yeah, we're not going to quite get into that depth at the moment, but yeah, that's a great point. Go ahead.
Were you going to talk about founder stock?
Founder stock in a C Corp, or we're not specifically going to get into that at the moment, right? I'm not sure if is Perkins Coie speaking today. Do you know? So the legal team might talk a little bit more about that when that comes up. But thank you. All right, let's talk accounting elections here. Let's do it. So right out the gate, right? First tax return you file, you're going to tell them how you're going to account for your income. There's two main methods. I'm not going to get into hybrid accounting or like completed contract method. There are other methods, but it's not really fitting this audience at the moment. So we'll talk about cash and accrual method specifically, and why you may or may not consider to do that. And there's rules where you potentially could not do that, as I point out here, right? So cash basis is generally not available to a business that has considerable inventory, and it's not available to C Corps with over $5 million in annual sales. So if you elect cash basis out the gate, there may come a time down the road that you have to convert to accrual-based accounting, okay? So cash basis, you recognize income when you receive. When that check comes in the door, that is income. When you write the check for the expense, you deduct it when you pay for it, right? So it's actually pretty efficient from a tax planning standpoint, because we can run projections into year and say you're going to have X figure of income, and you can say, well, gosh, I'm going to need X, Y, and Z in January. Just say buy it now, right? And let's take the deduction and wipe out taxable income now. So there's easier planning standpoints a lot of times with cash basis. Go ahead. I believe, I think I might have it on next slide. I think it's 25 million. A lot of figures in this head of mine. Not all of them are right? So But I believe it's 25 million, yeah. So an accrual basis is different. It's slightly more complicated in that you recognize revenue as you earn it, right? And you recognize an expense as it's incurred. And so it eliminates, it smooths some of the year-end planning opportunities that are out there for a cash basis taxpayer. But it's not the end of the world. It's not the worst thing. What is ironic, right, is the IRS actually encourages accrual basis, which always makes you pause, right? Why would they want you to be accrual basis? And is that smoothing effect, right? It's not as easy to offset income when you have to incur and actually, recognize this expense as it's recognized or incurred, I should say. So what happens, right? We've talked about some income limits. If you elect cash basis and down the road, fortunately, your business has grown enough where you have to now be accrual basis. There's a nice provision, right, where if you're impacted negatively, meaning you have more income to recognize under the accrual basis, you can you file a change of accounting method form 3115, and you can use tax code 481A, and that allows you to spread the income over 4 years. Instead of having one horrible year, you can have 4 not as horrible of years, okay? Questions on the tax or accounting side of things?
Well, I see the downside of accrual is if you have to pay tax on your accounts receivable, but you're saying you can spread that payment over 4 years?
Yeah, if you're cash basis, right, and you have a bunch of receivables out there, you're not going to pay on them because you haven't received the money yet. Whereas at accrual, right, you're going to pay tax on them as the work's performed, whether or not it's come in yet, prospectively. But yes, if you have to convert from cash to accrual and you have that poor impact of having high AR that's going to have a tax impact, you spread it over 4 years. Yeah, so you just divide it by 4, and each year you recognize that as income. Yeah. We good? Okay. So let's talk about costs of starting a business, right? We all wish it was free. It is not. And what the IRS loves to do is have rules about everything, right? Everything goes to a particular bucket, and they call things slightly different verbiage, right? So we have organizational costs, we have startup costs, and then we have operating costs. So organization costs would be like the general formation, right? It would be legal costs for the organization, necessary accounting services, right? You hear that? Necessary accounting services, expenses for temporary directors and organizational meetings. It specifically excludes costs of issuing stock, which is not deductible, so just be aware of that. Startup costs, right, would be advertising, generating brand awareness, right, making sure people know when you're going to open, what the product is, how they can find it, those type of things. And we'll get into R&D here in a minute, but what's important, right, is they treat these costs, organizational and startup costs, slightly different in terms of how we deduct them on the tax return. Right, in the year the active business begins, you can deduct up to $5,000 in startup costs, and any amount above that is then amortized, right? We take that over a 15-year period. But what happens, right, again, IRS loves these phase-in, phase-outs. What happens is if you expend more than $50,000 in either category, organizational or startup, you now have to amortize the entire amount, right? So you don't get that $5,000 flat amount out the gate. You're going to have an amortized amount that's drug out over 15 years, okay? So, well, you could actually spend $49,999 and still get the 5 and amortize the rest. But yeah, once you get over 50, they say you can't take the 5 now. You got to take it all over 15 years. So one of those odd little rules they built in there. I think we're good. All right, and this happens all the time where you incur personal expenses or you pay for expenses personally for the business before it's formed or before it actually starts, and that's fine to do that. We simply, from an accounting standpoint, we just treat that as a contributed expense. Okay, so relatively easy to do that. Just make sure you're tracking what those would be when those occur. Anything on that front? Startup-related costs, organizational, I think we're good. Did a sufficient job there. We'll talk about IP a little bit. And similar to organizational startup-related costs, right, we have these buckets to consider. We have research costs, we have costs of developing a patent, as well as purchasing a patent. They're all treated slightly differently. And remember, right, check your fact pattern with your CPA, make sure that all matches with what your expectations are. All right, so research and experimental costs or developmental costs, generally for reasonable costs related to development or improvement of a product. And we've got a whole list of what those might be, right? Model, process, formula. invention, technique, and patent, I would love to see one of each of those. I am not creative in any way, so I love to see what people generate that warrants, right, research and development. So that's pretty exciting. An important thing to note, right, is there's tax court cases that support, right, that the research costs are not limited, right, to an activity that becomes to fruition, right? It can be a failed project, right? You don't have to have some probable level of it being successful to deduct those expenditures. All right, so we'll talk about patent costs in general. So patent costs related to a patent that you yourself create, it would be like, right, the specific legal costs as well as administrative costs related to that patent. And then we add to that the cost of defending the patent itself. And then these costs, right, similar to some of those organizational costs, is that we depreciate them over the useful life or the legal life, whichever is shorter, excuse me. And that's different still from acquiring a patent. Patents that you acquire are not quite as generous as those you create, and that's because they mandate you use 180 months or 15 years to amortize that, and then any unamortized portion, right, is effectively lost until the business would be written off as worthless, okay? Questions there yet? Doing good? Hey. Never heard you before. Hey, Kevin, how are you, man? Good to see you. Yeah, it can. Yeah, we'll get into R&D specifically in a bit, but yeah, you can have wages relative to research activity. It can be in cost inputs as well. And it's a section 174 is the research costs. You may have seen that in some of your research, but there's a recent change to that rule, 1/1 of 2022, and it has to do, again, with how you deduct those. And it's one of those, again, incentive programs I talked about before, and that what they're trying to do is you get a more favorable or quicker deduction if the work is done domestically, right? In the United States, if you have work done internationally, it's deducted over a longer period. But yeah, those can be wrapped in. Good to see you, Kev. So here's a common situation, what might occur, right? A personal founder develops intellectual property and then founds a company to make use of that property. Without outside investment, it's completely fine, no problem in doing so. You will likely never get investors, though, if the IP is not owned within the LLC or the business, right, that they're going to invest in, right? Because they have no rights to that created IP themselves. So generally what we do is when that entity is formed is we can contribute it as an initial consideration, all right? And then additionally, the investors will be concerned about how you intend to protect that, should you face competitors or people breaching your patent itself. All right, so 174, thank you, sir. So yeah, we talked about research and development costs in general, right? And the rules had changed slightly in terms of deductibility. And it's specifically, I don't think I put the years on here, but domestic related R&D is now amortized as of the midpoint of the year. So you take the first year, you take it as July 1, even if the expenses occurred in December. Again, weird rule, but again, if it's domestic, it's over a 5-year period. If it's international, it's a 7-year period, right? So they kind of lessen the benefit in terms of timing of that. But this comes up quite a bit, and it used to be that it wasn't really a benefit to a company that was losing money, right? Because you wouldn't be able to get much of a deduction or benefit, I should say, from that. But the PATH Act passed a provision that you could use a credit, the R&D credit, to offset payroll taxes, right? So even if the business is losing money, if you're paying employees, you're going to pay payroll taxes. So payroll tax credit ended up being pretty efficient in those situations. Good there? There we are. We got more questions. I know we got more questions. Don't be shy. Oh, there you are. Go ahead.
So to follow up on the ID, could you comment more? Because my understanding we cannot amortize anymore.
You're required to amortize. You used to be able to take a more advantageous credit deduction relative to R&D, and now you have to amortize the costs, right? And then again, it depends on where the work is performed, domestic versus international. And that drives how quickly you can deduct those expenses. It used to be you had a portion you could deduct, and then you got a portion as a credit, which we love credits in the tax world. Those are dollar for dollar reductions in tax. So it's lessened the benefit. Yeah. Go ahead.
Is there a limit on that?
Yeah.
So is there a limit on that type of work?
Thank you, Shannon.
Question from Kev.
Thanks, Kev.
Yeah, okay.
I'm not aware of a limit in terms of the expenses related to that deduction. I think it's really fact pattern specific, right? And you probably want like an R&D type study done relative to make sure that reasonable costs related to what you're pursuing in and of itself. But we can chat a little more offline. Just love to talk to you in general. So.